Nancy Pelosi is betting millions that the AI boom is just getting started. Meanwhile, Berkshire Hathaway is sitting on a record $373 billion in cash, waiting for a crash. This is market research for education, not financial advice. If you want the truth behind the numbers, let's dive in. Today, we analyze the Great Divergence. Section 1, the offense, the Pelosi aggression. Okay, let's dive into this. We are stepping into the first corner of our heavyweight match, looking at a massive, high-conviction, all-in AI strategy. Driven by her husband Paul Pelosi's trades, this specific portfolio has become one of the most heavily scrutinized and, frankly, heavily copied strategies on Wall Street today. And when you look at the sheer staggering scale of this outperformance, it's easy to see why. You aren't just looking at a slight edge here. You are looking at a historical return of 874% for the Pelosi strategy. That completely dwarfs the 283% return of the S&P 500 over the exact same time frame. Add to that a massive 41.7% return right through the volatile 2025 to 2026 window. Regardless of any of the political controversies surrounding congressional trading, strictly from an analytical standpoint, these numbers represent the ultimate growth signal in modern markets. So you might be wondering, how exactly are they achieving these astronomical returns? Well, it's not just by logging into a brokerage and buying regular stock. The real core engine of this strategy is LEAPS. That stands for Long-Term Equity Anticipation Securities. Essentially, these are highly specialized, long-dated options contracts. They allow the portfolio to control massive blocks of stock in too-big-to-fail tech giants for just a fraction of the actual share price. It acts as immense leverage. It amplifies their gains exponentially during this tech bull run, and they do it all without having to tie up billions in baseline capital. It's aggressive and it's highly calculated. And applying that kind of leverage leads to some very concrete portfolio targets. The strategy heavily targeted NVIDIA, as you'd expect, but it also placed massive bets on Broadcom. Specifically, we're talking about the exercising of 200 Broadcom call options, brilliantly timed right as the company boasted a guaranteed $73 billion AI backlog. And then there's Tempest AI, which is a healthcare AI diagnostics firm. Right around the time of her options purchase, the company launched a brand new AI concierge app. And boom, the stock saw a staggering 121% surge. This is what highly leveraged, high-conviction offense looks like. Section 2, the defense, the Berkshire Shield. All right, take a breath because we're stepping into the opposite corner now, shifting from fast-paced momentum to the absolute pinnacle of defensive value investing. Focus your attention on this colossal number. Remember that $373 billion pile we mentioned at the start? Well, it has now actually swelled to a record-breaking $397.4 billion for the first quarter of 2026. Let that sink in. While the momentum chasers are out there buying every AI dip, Berkshire is doing the exact opposite. They are hoarding cash like never before. In fact, during that quarter, they were net sellers of equities, literally dumping $24 billion in stock. They are pulling chips off the table. And this quote right here, directly from CEO Greg Abel in May 2026, really serves as the philosophical anchor for this massive cash pile. He stated quite simply, "Our capital allocation approach is aligned with our owners and shareholders." Abel has fully inherited Warren Buffett's legacy, and it's clear he is doubling down on it. What does that mean for us? It translates to an unyielding dedication to extreme risk management and maintaining a strict 20-year value horizon. If the pitches aren't fat and the companies aren't cheap, Berkshire simply refuses to swing the bat. So what exactly is Greg Abel seeing out there that makes him so cautious? Well, for starters, we're dealing with sticky, unyielding inflation hovering right around 3%. On top of that, there is a complete lack of reasonably priced corporate acquisitions in the market right now. And critically, escalating geopolitical tensions in the Middle East, specifically around the Strait of Hormuz, are a massive factor. You see, Berkshire's core strength lies in the real economy. We're talking physical railways like BNSF and massive energy infrastructure. They are actively feeling the friction of the physical world, which stands in stark contrast to the completely frictionless virtual economy bets made by the momentum traders. Section 3, the arena, the valuation gap. Okay. We've seen the offense, and we've analyzed the defense. Now let's examine the actual economic battleground that both of these strategies are currently operating within. Check out this number, 226%. This is the current reading of the infamous Buffett indicator. If you're not familiar, this metric measures the total market capitalization of the United States against the country's GDP. Historically speaking, crossing the 200% threshold is a blaring red siren. It is a level that universally signals extreme, potentially dangerous market overvaluation. And this brilliantly illustrates the disconnect. The historical average valuation safely sits around 127% of GDP, but today's tech-driven reality is towering at 226%. We are sitting significantly higher than the absolute peak of the dot-com bubble. When you realize that the S&P 500 forward price-to-earnings ratio is currently sitting dangerously above 28 compared to a long-term historical average of just 17, you understand exactly why Berkshire is hiding behind a nearly $400 billion shield, all while Pelosi bets that these too-big-to-fail tech giants will just keep on running. Section 4. The Verdict. A conflict of philosophies. We've arrived at the center of the ring to directly contrast two fundamentally opposed eras of capitalism. Breaking it all down, we are really watching a philosophical war play out in real time. Under the Pelosi vision, the time horizon relies heavily on rapid insider and political momentum supercharged by auctions. The core focus is strictly the virtual economy, semiconductors, AI algorithms, and cloud data. And the current stance, absolutely all in and heavily leveraged. Contrast that directly with the Berkshire vision. Their time horizon is a patient, deeply risk-averse 20-year stretch. Their core focus remains firmly anchored in the real economy, moving heavy freight and generating physical power. And their current stance is just to wait, build an impenetrable fortress of cash, and protect their value at all costs. In a market this split, you are either a momentum chaser or a value protector. I'm tracking both in real time. If you want to see which side of history wins, subscribe to Balance of Economy. I'll see you in the next briefing. Stay sharp and stay informed.